In this video, I'm going to talk about stocks and bonds, but I want to start by recapping the role of financial intermediaries. Generally, the way we think about intermediaries working is that they sell you some kind of asset, and then they use the money that they get from that sale to do something productive, and then they send some of that money back onto you later on. But that's only superficial. What's really happening is that you're sort of renting your money out to them. Okay, so they're actually going to pay you for the use of your money, and then they'll give you the money back at the end, and the price that they pay for that rental is called interest. Of course, the fact remains that they're sort of selling you something, either a promise to repay or a share of ownership in something, and those things that they sell you that represent promises to pay or a share of ownership or something you can get money out of in the future is called a financial asset. Now, just as better forms of money allowed societies to use more of their resources and therefore become more efficient, new kinds of financial assets, or the invention of financial assets in the first place, allowed societies to use more of their resources, because now they weren't just using money in order to make trading more efficient. They were now actually able to prevent money from just lying dormant when people didn't want to spend it right away, and instead that money could still go to productive purposes. These assets take two basic forms. One is sort of an IOU, a promise to repay, a loan. And the other kind of financial asset is actually an ownership stake in a corporation or something like that. So one represents debt, and the other one represents equity, which is another word for ownership. The first kind of financial asset I'm going to talk about is bonds. To the best of our knowledge, bonds were invented in Florence in the Middle Ages as a way to help them pay for their wars. So what they did was they had these pieces of paper that they would sell to their citizens, and the pieces of paper said that we, the city of Florence, will repay you after a certain period of time the money that you gave us with some extra interest, right? So this worked out for Florence because it enabled them to raise more money for their wars, and it was an attractive investment option for their citizens because even if the risk was very low, because even if Florence didn't have the money on hand at the end of that period of time, they could always just raise taxes. So this was a major step forward in finance, and it should not be thought of as a coincidence that Florence was subsequently the center of the Italian Renaissance. So bonds have three parts. They have a face value, so however much you had to pay for them, however much you were lending to the bond issuer, which is called the par value. So par is what you expect to get on a hole in golf, right? So par in this case is what you expect to get back at the end of that period of time. And the period of time after which the bond is going to be repaid is called maturity. So that might be something like 10 years. And then the rate of interest, so that's usually some kind of yearly or quarterly payment from the bond issuer to the bond holder, is called the coupon rate. So this isn't usually like a percentage, it's usually like some fixed amount of money. So let's say the bond was originally worth $1,000. That's how much the bond holder had to pay for it. Maybe the bond issuer pays $50 a year to the bond holder. So that would be a 5% rate of interest. As you can hopefully see, this is basically a loan. But unlike a normal loan, this is a loan that you can actually sell to someone else if you decide you want your money sooner. And that's a good thing. It would be hard to entice people to lend their money if they thought they couldn't get it back for 10 years no matter what. But instead, you can sell that piece of paper that entitles you to a yearly payment and the repayment of the original amount of money at the end. You can sell that piece of paper to someone else. Now, hopefully you can sell it for, close to what the bond was originally worth. So if you paid $1,000 for the bond, hopefully you can sell it for $1,000. But that might not always be the case. For example, if the interest rate offered on new bonds went up, nobody's willing to buy your bond for the face value anymore, because they can just get a bond that pays a higher interest rate from somebody else. So you might have to actually lower the price that you're willing to sell your bond for. So let's say you bought your bond for $1,000 and it pays $50 a year. Now somebody can get $50 a year on a new bond that they only paid $800 for. So now you actually have to sell your bond for $800, or else nobody's willing to buy from you. So you took a loss on it. You're probably not willing to do that unless you need the money, but you might encounter a situation where you need the money. So that's a risk that you take on when you buy a bond. So where do bond interest rates come from, and why might they change? Well, we already talked about how returns on assets are are determined. They're determined largely by risk and liquidity. Because there's a secondary market for bonds, they're a fairly liquid asset, but their risk will depend on the bond issuer. That's why Greece, the nation of Greece, has to offer a higher interest rate on bonds that they sell because it's a much riskier investment, whereas the United States government can sell their bonds at a much lower interest rate because it's much more certain that the bond will be repaid at the end of however long it is. We actually have, to facilitate this process, bond rating agencies that investigate how financially sound a company or a government is that's issuing a bond, and is able to determine how risky that bond is. And the riskier the bond is, the higher the interest rate that the bond issuer is going to have to offer. As you've hopefully also been able to determine, bonds are basically the way in which governments go into debt. So the U.S. debt, the national government debt, which is currently around $16 trillion, is composed of bonds that are held partially by private individuals in the United States, and some by foreign governments or foreign individuals, but that's how we raise money. But governments aren't the only entities that raise money by selling bonds. Corporations are also able to sell bonds in order to raise money. So if you want to invest in Ford, you could buy Ford stock, but you could also buy Ford bonds or GM bonds or Chrysler bonds or something like that. There are also municipal bonds that are issued by state and local governments to pay for various projects like a new school or roads or something like that. Now, bonds might seem like a really risky investment, but they're actually less risky than stocks. Because in the case of bankruptcy, stocks will essentially just become worthless. But bonds actually have to be repaid first, if they are possible to be repaid. So the level of risk is a little bit lower, which also means that the potential returns from bonds tend to be lower as well. The second kind of financial asset that I'm going to talk about is stocks. And stocks basically go along with the invention of the joint stock company, which is a company not owned by an individual or by a partnership, but by anyone who owns shares, and those shares can be traded so that the ownership can constantly be fluctuating. And the real advantage there, as I've already talked about, is that none of the individual shareholders have complete liability for the company's debts. So it's a more attractive way of sort of owning a company, and it makes people more willing to get ownership in a company than they would otherwise be. Some of the earliest joint stock companies were things like the Dutch East India Company, which was publicly traded on the Amsterdam Stock Exchange in the 1600s, and the East India Company that was chartered by the British Crown and became so powerful that it basically, by the end of its existence, basically controlled the entire nation of India. A share of stock represents a piece of ownership in a company. So it's very different from bonds in that bonds are a debt. It's a promise to repay. You don't actually own part of the company, right? China, insofar as it owns 12% of U.S. government debt or so, doesn't own 12% of the United States or have 12% influence over United States decision making. That's not the way it works. With stocks, it's different. With stocks actually represent a share of ownership. Another word for ownership is equity, and that's why stocks are oftentimes referred to as equities, whereas bonds are called debt securities. Now, stock prices are not, scientifically derived from the value of the company, but we think that they're determined largely by the value of the company. The prices of stocks are a function of the supply and the demand for those stocks. So stocks that are highly demanded are going to be worth a lot of money. Well, why would people demand a lot of a stock? Or why would people demand one company's stock as opposed to another? Well, they demand that company's stock because some stocks pay dividends, which are a share of that company's profits. So the more profitable investors believe a company will be, the more they're willing to pay for a share of that stock. But not all companies' stock pays dividends, so why would anybody want those stocks? Well, the other thing that can happen is that a company can be sold, and this happens a lot. Okay, this happens all the time. And if a company is sold, then whoever's buying the company will pay all the shareholders, a portion of what they paid for the company. So if a company is sold for $50 million, then the shareholders are going to get whatever percent of the company they own. That's the percent of the $50 million they're going to get. Just the value of the company in itself is a powerful incentive to buy stocks or buy shares in that company. So there are basically two ways of making money with stocks. You're not earning interest the way you do with a bond or with some other kind of loan. Instead, you're either collecting dividends from the profits that the company makes, or the company reinvests those profits so that the company becomes more valuable, and therefore your stock is more valuable if you decide to sell it, or if the company is sold to someone else and you can get money that way. And so you either earn money from dividends or from what's called capital gains, because the stock grows in value and you sell it for more than you bought it for. Now, stocks have a much greater potential for high returns than bonds do, but they are proportionally more risky, because if the company goes out of business, the bondholders will still be repaid, at least insofar as the company is able to repay them, but the stocks could actually become worthless. And this happens sometimes, that a stock, maybe you bought a stock for $20 a share, and the price goes down to a penny because the company basically becomes worthless. Hopefully, as I'm talking about these things, you guys are beginning to see that financial innovations, financial inventions like the joint stock company or like bonds are actually just as important, or potentially even more important, than any single mechanical invention that has ever been made to the development of economies throughout history. So that's basically what I have to say about stocks and bonds. And the question I'll leave you with is, if you have some extra money lying around, which would you rather invest in?